Uh, Good afternoon and or good morning, everyone, or good evening, depending on where you are around the world. Thank you for joining the RICS webinar. Today, we'll be talking about something called the Property Valuation Framework. It's something that has been developed by the Academy, RICS Academy. We've been doing this training for a while. To some contents in the Middle East. Even though this has been prepared for the Middle Eastern and Africa audience, however, this is, in my opinion, applicable to anywhere around the world. My name is Dr. Tarek Madany, and I will be presenting the webinar today. What I do is I'm the managing director of a firm, a valuation firm called Global Appraisal Tech. I'm doing valuations for over 15 years now, and I am a RICS registered valuer, among other local qualifications in Egypt and Saudi and UAE. I also teach at the university in Cairo, Egypt, and I am a board member of the World Regional Board of the RICS in the Middle East and Africa, as well as a board member of in Egypt of the RICS. I have done a lot of valuation internationally. I've been all around the world, Canada, the US, UK, and Middle East. This is my email, my phone number, and my LinkedIn. I would be happy to have you contact me for any kind of partnership in the future. Today we're going to be covering something called the 7-tier valuation framework, and this is basically, it's intended to be a map. As a valuer, we are always confused when we get an assignment, when we get instructions. Where do we start? How do we go about selecting the right method, the right approach, the right basis of value, etc. And today we're just going to cover and touch on the basic principles and the definitions and sort of of this framework. And obviously, this is not any kind of training for doing valuation work in the future. However, it does. We do have training at the RICS Academy for diving into the actual methods and the methodologies and case studies and problems and things like that. So this is sort of, I guess, a way to promote our courses and CPDs on the Academy. So today is just going to be a flavor of what we offer. However, hopefully we'll also be getting out with very important insights, hopefully, and an important, I think, methodology or a framework about to be thinking about evaluation assignment. The seven tiers or the 7 components of the framework are as presented in front of you. The first thing is the type of amount. So the first thing we always ask is, what is it that you're trying to give an opinion of in your report? Are you giving an opinion of price, an opinion of cost, an opinion of worth, or an opinion of value? The second thing is assumed use. What is it? What is the type of asset that you're trying to give an opinion of value of? Is it land? Is it residential, commercial, specialized, building, plant and equipment? You have to be aware of what it is. It might be a component, maybe a mix of each, etc. You have to be aware of the purpose of the valuation. The number 4 is something called the premise of value. Number 5 is the basis of value. Number 6 is the selection of the right approach. And number 7 is the selection of the right method. So we'll be covering each one of those in this webinar today. And if you have any questions, please do throw them in the chat, and I'll be happy to address them, hopefully either through or at the end of the webinar. So the question always becomes, well, the first question you got to ask is, what is the amount that you are giving an opinion of? What are you giving an opinion of? Are you giving an opinion of price, cost, value, or worth, and what is the difference between them, right? So according to the standards, a price is just a label, right? It's just a number that you put on an asset to be sold or bought. Uh, so why is price not value? So the question is, so how does value differ from price? Well, value is essentially the estimate of the price that would be achieved if a property were to be sold in the market in at the time of the valuation, meaning that a price could be loaded with installments. It could be loaded with payment terms, etc. So you can come and say, for example, in many parts of the world, like in the Middle East and other parts of the world, you can come and say the price of this house is, I don't know, $200,000, right? But and the price of the house right next to it, which is identical, is $150,000. Well, what's the difference between the two? They could be identical. Well, one could be sold over installments, like with sort of a payment term with interest built in, and the other one is paid in cash, right? So the question becomes that price is just a label void of context, while value is the present equivalent or the present value of that price. These are the differences. These are the nuanced difference between price and value. And then we'll talk about basis of value. Values come in different numbers, different amounts as well, depending on the basis that we're going to be using. So we're going to be talking about that. But price is just a buying and selling label that is could be cash, could be installments, could have payment terms, etc. Cost, on the other hand, is a costing. It could be the price, it could be the value, but most likely cost is under price, is usually is a value or is an amount that's below the price, because the difference between the price and the cost is the profit margin or the loss, right? It could cost you more than the price to build something or to construct something, or it could cost you less, which is the normal equation, cost you less than the market price or the market value of this product that you're trying to, the asset that you're trying to construct or build. So this is different sort of take on an amount. Worth, is, on the other hand, is a specific investor's perception of value, right? So even if the market, if you're looking at a market value, for example, a plot of land that's being sold and bought, which is subject to the uh, sort of the influences or the dynamics of demand and supply, uh, is so demand and supply determines the equilibrium point at which the market is willing to buy or sell a specific, say, plot of land. For an investor, it could be worth more or less than that market value. Well, how's that determined? By using some kind of, we'll talk about this in the methodology, but it's basically maybe an investor looks at it from a DCF perspective or residual land value perspective, where they are capable of, building a specific project that gives them sort of a residual for the land that is higher than the market value that's being bought and sold, because they have a special edge, or lower, could be not worth paying that much for this plot of land because it's not going to make the project feasible, right? So worth is a different perspective of the amount that you're trying to give an opinion of, because it puts in mind other kinds of influences, KPIs that the investor is um, looking at, such as risk and reward, which is reflected in the discount rate of the discounted cash flows of the project that the investor, for example, is going to be um, managing or building or developing on that plot of land. That's an example of why worth could be different than value, than cost and price. These are just different definitions of sort of the figure that you're trying to give an opinion of. It's very important as a valuer that you understand the context of your valuation assignment, so that you'll be able to give the right opinion of price, cost, value, or worth. For the same project can have four different outcomes. The price could be, you can come to a developer and say, this apartment, you can price it at $200,000 over a 4-year installment because that's the market trend. That's the market price, and this is how the market sells. The value of the $200,000 is actually equivalent to $150,000 in present value terms because the interest rate or discount rate is 10% annually, right? The cost of building that apartment could be $110,000, and the difference between $110,000 in present value terms and $150,000 in present value terms is your net profit, is your present value of your profit, right? In accounting terms, it's the actual profit, the cash flow is between the 200 and 110, which is 90,000. So that's the accounting profit, right? With the nominal versus the real. But what is worth to you, for example, could be the worth to you could be, well, in that case, there's no worth, but the plot of land, I guess, would be worth the residual between the present value of selling it, which is 150, minus the present value of its cost, which is 110, including profit. So what is residual for land is $40,000, divided by the per meter square or per meter foot of the land, which whatever it is, the floor to area ratio is. This is the maximum you'd be allowed. This is the maximum you'd think about buying this plot of land for to make this project and this profitability feasible. Profitability achievable. Therefore, if the market value of this plot of land is offered to you for less than amount, then good for you, you'd make more profit. If it's more, then it's not worth it. You're going to cut into your profit, right? So this is sort of how you apply the four sort of terms onto an example for, let's say, a developer when you're doing evaluation. Here's an example of the difference between price and value, and this is why it's sort of put in red. Right. So if the price is in cash is $350,000, that's one developer, for example, selling let's say an asset for $350,000 in cash, while another one is selling the same type of asset for $400,000, but with a 10% down payment and equal installments over 5 years. What is valued more? So which one of those has a present value higher than the other, right? Novice valuer would say, of course, this is valued more. This is sold at 400,000, while this one's sold at 350. Therefore, the asset B is more valuable than asset A. But a seasoned valuer who understands the difference between price and value would actually calculate the present value of these installments given the discount rate, let's say, of 10%. And if you do a quick calculation, you'll find, I don't have the math right now, but we'll have the time to do it, but you'll see that actually this is closer to a present value of, let's say, 312,000, I think. Someone can correct me if I'm wrong. So that makes actually asset A worth more than asset B, right? So the answer is asset A. So the one that's priced at 350,000 and actually sells is higher in value than the one that sells at a price of 400,000 with installments. Okay, this is just an example of the difference between the two. If you have any questions, happy to take them. Please write them down. Now, the second part of the framework is the assumed use. It's very, very important as a valuer to understand the context of the asset that is sort of under valuation, right? If it's a land, well, you need to ask the question: is it an empty land, or is it a development land? Is it set for development? Well, what's the difference between the two? It could actually influence your methodology, right? You can say that an empty land, there's comps for empty lands that are being sold by the government or sold by individuals in the secondary market. You just do a comp analysis. While a development land could influence the behavior or the methodology that you're going to approach, and you can say, well, a land that's set for development, I have to understand the development scheme, the context of the development, and I might actually be producing a measure of worth or an opinion of worth, not just of market value. And even if it's a market value, then given the actual context of the development scheme that's been already approved by government, sort of been, there's investors, banks, etc., already involved. Therefore, it's a fact. It's going to be a market fact. Therefore, I might want to value the land in the context of its development scheme, right? Which case you would choose a completely different method, not just comparatives, but you have to look at the development scheme do a residual land value, and in which case it's a different method and a different value altogether. The development scheme could, cause the empty land's value to increase or decrease depending on its feasibility, right? Which is a fact at this point of doing the valuation. Residential, also, you can look at something, an asset that's residential. You have to basically make sense of how it's being used. What's the assumed use of that residential? We always talk about assumed use in the context of the asset, the type of asset. So, is it owner occupied? Is it vacant? Is it leased? Right? What's the difference? Right? It can actually influence the method that you're going to be using. If it's owner occupied or if it's vacant, then when you can just use the comparative approach, the comparative transaction method of similar owner occupied assets or empty assets. Or if you do a term and reversion, if you do an investment method on it, you are not tied or bogged down by an existing lease on it, right? You can assume that you can, after you study the demand and supply in the market, you can already assume that's going to be leased at market rent, for instance, which influences its value. But if it's already leased and there's already contract on it, let's say this is a multi-year lease, maybe a long-term lease, a short-term lease, then you have to put that lease into effect. If the lease that's on it, which is the passing rent, is below market rent, this is going to affect your value of your residential property negatively. If it's above your market rent, then it's definitely going to give you a premium, right? Because the logic says if you're going to be selling an apartment, a residential apartment, or a commercial shop or something, that with a tenant, if this tenant is paying above market rent, then you're giving the buyer, the buyer who's going to buy from you, someone who's giving you a higher yield than the rest of the market, right? So you got to sort of factor that in. If it's below market rent, then you're giving the buyer a tenant that's paying below market rent, so you have to give them a discount, right? And there's methods to calculate this. This is not a webinar on methods right now, it's just on the framework. However, if you contrast that with an owner-occupied or a vacant, say, apartment or shop, you don't have this. You don't have this issue with an existing lease that could affect your apartment or unit positively or negatively. You do have other factors such as what is the average vacancy, the holding periods, the grace periods, the occupancy rates. There's other factors that get involved in an owner-occupied or a vacant apartment, but it's treated differently than an existing tenant leased apartment with a tenant in it. So again, it's very important when we take a residential assignment to value a residential property. What is the assumed use? What's the current state of its occupancy? That affects the method and affects the output. We look at commercial. Well, again, there's two types of categories of commercial properties. There's leased properties, like we're looking at the rent schedules, like retails and offices, maybe malls, etc. When it comes to analyzing its DCF or analyzing its income streams, its operating revenues, etc. You're looking at your top line in your DCF is your top number is rents, right? In which case you could use the investment method, for instance, can influence your method. But if it's an operating commercial property like hotels, hospitals, cinemas, private schools, petrol stations, then the top figure is not your rents, most likely. It's actually the operating revenue of that facility. For a hotel, it's average daily rates multiplied by days of operation, by occupancy. You're looking at actually an income, a P&L, and a cash flow statement of a hotel business, not of an asset. The top number is not rents. The top number is actually the revenue of the occupied rooms and F&B and et cetera, et cetera. Same thing with hospitals, same thing with cinemas, looking at tickets, et cetera. And then you try to, at the very bottom, at the NOP, net operating profit, to assume, let's say 50/50, 30/70, whatever it is, the going market rate of dividing your NOP between what would be a fair market rent and what would be a fair profit of the business, and that would be the profits method, right? So it affects, so a commercial property that is leased versus operating can actually affect the method that you're going to be using. If it's a specialized business, a specialized building, that's something that's built for purpose, like a government, a house of worship, a ministry, even a factory, like that's a production line that's unique, that's built for a purpose, etc. Then you're looking at possibly not able to look at something that has apple to apple, doesn't have a market, doesn't have a income uh, uh, stream. Therefore, you cannot use the market approach. You cannot use the income approach. Then you're left possibly with the cost approach, right? And the type of asset, if it's specialized building or if it's plant and equipment, obviously plant and equipment has its own treatment, but you might be looking at different methods and methodologies that would affect your opinion of value. Same thing with plant and equipment. Plant and equipment is IVS 300. Obviously, land, residential, commercial, specialized building is IVS 400 and 410. Therefore, it's the same principles, same approaches, same methods, but the applications differ. So if you get a plant and equipment, the way you apply the DRC, depreciated replacement cost method, or the income approach to the market change is completely different. The way you apply to the IVS 400 and 410, which are the other asset classes. So there's sort of a split between in the application of the methods between IVS 300 and 3IS 400 and obviously development, which is 410, right? So this is something that you have to be able to dissect in your asset. You might be getting a complex, an industrial complex. It might be part plant and equipment. It might have a hotel, a rest house in it, might have office buildings in it. So you also might have to be able to break down your asset if need be, if it's a big complex or a city or mixed use project or something. The third component is the purpose. The purpose of the valuation obviously affects the end result, affects your methodology, affects your approach and method and your basis and your outcome. I'll give you an example. If you're doing evaluation for securities, so if you're doing basically a bank loan, then what does the bank really care about when you give them the value of an asset? They care about, if it's for a mortgage, let's say, then the bank is going to lend against the value of a potentially failed um, or a liquidation state, right? So if a bank lends a borrower for a mortgage for an apartment, then what they care about is if the buyer defaults on their payment, they lose their job, they can't continue paying anymore, then the bank is going to have to repossess the asset and then possibly auction it off for sale. So what they actually want is what is this value, this liquidation value, um, when the borrower defaults. For residential property in some of our countries and regions, it might be not different than the market value. I mean, God knows in some of our countries, when a bank repossesses an asset and actually sells it, it's actually higher than what the buyer actually bought it for. So, you know, good news. But if we're talking about, let's say, a project, not a tenant, like not a residential house or a shop, but let's say it's a project that fails halfway through construction, then we have an issue, right? At the beginning, the project could have had the reputation of the developer. The developer would have basically given the buyers the sort of confidence to pay above market average, above competition for certain sort of units inside that project or whatever. But then halfway through, the developer goes bankrupt. The bank repossesses the asset. Now the bank has a project that's halfway done with the reputation of the developer tarnished, right? So all of a sudden now you're left with a bag of assets that are toxic, right? Well, in this case, the bank might not be actually able to sell it at above market price or at market value. It might have to be at liquidation value. You're selling it to another developer. that's going to have to make a profit, right? It's going to take a failed project, spend a lot more money on it to fix its issues. It might be already been overspent on it, the previous developer, so it might have to do some changes and design changes, etc., which are going to cost them money, and it's going to be, at a fair price, to make them be able to entice them to turn it around, resell it, and make a profit, right? So in this case, it might actually influence your method. Instead of using sort of the comparative method, let's say in the case of a mortgage for a unit, to using the residual method if it's a project under construction or a project that's sort of given it's project finance, right? So again, the context is very important. It influences, and the user of the report, or why it's going to be using, what's the purpose of that report, is going to influence the outcome and the methodology that you're going to be using. It's different than insurance. Insurable value, for instance, if it's going for an insurance company, in many of our countries, insurance policies don't cover the value of land. For instance, land is uninsurable. Let's say, I mean, yes, your insurance policies might cover earthquakes, might cover fire, but neither do these two disasters or even floods. Neither of those three disasters can affect the land unless you're a coastal city, in which case you're insuring against land, which can be submerged underwater. That's a different story. In some cities, that's the case. But, again, it's down to the nuances of understanding what the insurance policy covers. Therefore, you have to be able to dissect the insurable value. Plus, the insurable value has nothing to do with market value. It has to do with market cost, right? Remember what we talked about? Cost, price, cost, value, and worth. Insurable value is worried about replacement cost. It doesn't matter to me if your building is 50 years old, an earthquake comes and destroys the building. I'm going to have to give you, the insurance company is going to have to produce a compensation that allows you to rebuild that building or fix it at market cost, not at market value, right? So this is the issue with insurable value, is that it actually addresses cost, not value, right? Same thing with auctions. Auctions could be, forced liquidation or order liquidation. You have to be able to decipher. Purchase price allocation, for example, that's an accounting. So some companies come and they say, a company bought another company on the books or based on their income approach or part of a big deal, and with that deal they get a bag of assets. So not just they don't just buy uh, the company in the stock market or whatever, but they inherited the assets with them, the land and the buildings and the equipment and etc. So a purchase price allocation is when an accounting firm comes to your valuer and says, look, we need to be able to tell the difference between the tangible assets and the intangible assets. There's part goodwill and there's part actual tangible assets. If the tangible assets are in value, the market value of those assets are higher than the purchase price, then we have to do an impairment. If it's below, then we have goodwill, right? So becomes okay. So what method do you use, in order to do a price purchase allocation? Again, it depends on the type of assets, the dissection, but most likely, if it's let's say a complex assets, a specialized asset like a factory, a company buying multiple factories, etc., it's going to be a mix of methods depending on what determines market value for those types of assets. It could be for liquidation, right? You're looking at something that's again orderly liquefied or forced liquidation. Each one of them has its discounts and its methods in substantiating and producing an opinion of value. The fourth component is called the premise of value. The premise of value is essentially an assumption, right? It's what are we assuming the underlying assumption of value is. The four ones that are typically used in the standards is highest and best use, or sometimes also used as called the development potential. It's also referred to as development potential. The second one is called current use or existing use. Also, in some other terms, they use the word ongoing concern. So it's to be used as is continuously, current use, ongoing concern. And then the other two are orderly liquidation. So you are selling the asset and you're liquidating it in an orderly fashion. I'll give you some examples of that. Or forced sale, right? So I'll give you an example. One example could cover all four premises. Let's say a client comes to you and says, I want to value my factory. Okay. if you look at that factory and you determined that the plot of land where that factory is built on actually only just recently been rezoned to a commercial use, right? So in fact, here's where the current use as a factory is out of sync with the new zoning of the plot of land. So you can come to the owner and say, by the way, your plot of land is worth a lot more than the factory, being it the factory. So I'm going to be valuing it as highest and best use, because a reasonable buyer most likely is going to buy this old factory. Let's say it's an old factory. It's going to buy this old factory, knock it down, and actually construct a commercial property that's worth a lot more, let's say, in that region or that country. So therefore, if the premise of value of that factory is highest and best use, a commercial plot of land, then you're actually valuing a commercial plot of land. You're not valuing a factory, right? But another example, let's say, just a separate example, let's say another client comes to you and says, I want to value my factory, and you come and say, okay, what's the profile of the buyer? And he says, well, the buyer is a competitor or is an investor who's going to come in and continue using the asset as is going to actually improve its performance, invest a bit more in more equipment, etc., marketing, and they're going to be, um, continuing the operation of the factory. In which case, you are valuing the current use. You're on an ongoing concern premise, right? This whoever's going to buy this equipment and the land and the building is going to continue to operate it. A third example is a third client coming in and saying, I want you to value my factory. Okay, what's the assumed use, or what are you going to be using? What is it for? Well, it's arriving in its end of useful life, and I was working in the steel shaping industry. I want to sell it as a regular, it's just a core and shell, sort of um, a general purpose factory. Whoever's going to buy is going to maybe change its use to food processing or clothing, in which case the equipment that's inside is going to be liquidated. Once you remove the equipment from inside the factory, or sell it outside, or discontinue the operations of the factory, all of a sudden it's a liquidation event. Therefore, the value of the assets inside are no longer ongoing concern. They're going to be removed. They're going to be discontinued. Therefore, you cannot look at it as another factory. The second case, which is a factory that's going to continue operation as is, because then there's the cost of dismantling, moving, the cost of commissioning and testing again if the equipment is actually usable somewhere else, or just salvage and you want to sell it. So in which case, the order liquidation in the third case example is definitely much less, could be much less than the second scenario, right? You're still valuing a factory, but a factory that's going to continue operation is different than a factory that's going to be dismantled and moved, because there's cost of doing so and there's risk of doing so. And that has to be factored in. The fourth case is a forced sale. Let's say, again, a fourth client comes to you and says, I want to value my factory building. And what's the case? Well, unfortunately, I'm going bankrupt and I want to auction it off. In which case, it's most likely going to be auctioned off at a significant discount, right? It's going to be repossessed by the bank or by the whatever, the people who lended me money and I can't pay them off, whatever it is, the bank or the mezzanines or the investors, etc. So these are, four scenarios, four factories. They could be all on the same street, for all I know, but every one of them has a completely different premise, and that affects the value, right? So we have some definitions in the slide. Highest and best use. How do you determine highest and best use? It is what would produce the highest value for an asset. So even it's applied for non-financial assets. So as in tangible assets, also applies to financial assets. There may be circumstances that the highest and best use of financial assets needs to be considered. The highest and best use must be physically possible. So you cannot assume a scenario out of thin air, right? It has to be financially feasible. It has to be legally allowed and actually results in a higher value, right? Knocking down a four-story building because the zoning allows you to build a five-story building is not feasible. Even though it's higher, better use, it might not be feasible to knock down an entire building just to increase a floor, right? To build a new building with an extra floor. But knocking down, let's say, a one-story building because you have a potential of building a 12-story building might actually be financially feasible and gives you actually higher value than the one-story building, right? It has to be legally allowed. You can't just come and say, oh, I like your farm. I think I'm going to be using the assumption it's going to be a commercial plot. No, you have to have evidence or of zoning change, or you have to have actually a license that gives you um, like a rezoning license or a deed or something that says that actually this is a commercial plot. It's just being used as a farm right now, right? So then, it's a fact. It's not a study, right? You cannot do a valuation on a study. You have to be doing valuations on facts. All right. Current use is sort of we've mentioned that it's the actual. It could be the highest and best use. I mean, a residential apartment is a residential apartment. There's no really higher and better use than having it be considered residential, or it could not be. But it's basically the ongoing concern value, right? Being used as is in its current form. Order liquidation, on the other hand, is, could be realized in liquidation sale. Liquidation sale is, but at a market sale, it could actually produce a value higher than market value. There could be so much demand, and it can go into a bidding war, and in a case, it can actually give you a value that's exaggerated above market value, or it could be less, right? But again, it sort of follows the same reasonable period of time to find a purchaser, may vary by asset type and market conditions. So, you're not in a rush to sell. You're looking for the highest bidder, but it's not you're selling the assets piecemeal or as is, but not for an ongoing concern. It's not going to be continued operation necessarily. It's not the main assumption. If it does, then good for the buyer. But if they don't want to continue the operation, then that's the value that is liquidation. A forced sale, on the other hand, is um, it could be on any of the following conditions: a short period of time. It could be subjected to market conditions prevailing as of the date of valuation or assumed timescale within which the transaction is to be completed. So it's restricted by time. There's a compulsion to sell. The buyer is typically motivated. Payment will be made in cash. There's no normal marketing effort. It's not impossible to apply normal marketing because of the brief exposure of time. So it's forced. It's a forced sale. It's a fire sale, essentially. Right. The fifth element is something called the basis of value. It's IVS 104. So again, bases of value are different definitions of value. The most common one that we use is what we call market value. Market value has a very specific definition. It is the estimated amount. Remember, we said price, cost, value, and worth, and we said value is an estimated amount. So value is an estimated amount. It's a value for which an asset or liability should exchange at a valuation date. So you have to particularly valuation date meaning now, cash, or the date that, let's say, sometimes you're asked to value a property as of the closing quarter, last quarter, or closing year, 31st of December. So that could be the valuation date. It's a specific, point in time between a willing buyer and a willing seller. So there's no compulsion, there's no forced sale, there's no economic event that's forcing someone to buy or sell. In an arm's length transaction, right? After proper marketing, where the parties had each acted knowledgeably, prudently, and without compulsion. The key here is market, right? Market here is, we'll talk about this in a bit, is demand and supply, right? So this is the demand and supply curve, right? We have quantity, or this is price, and quantity. So essentially you have many, many participants buying and selling. So this is the normal sort of, there's alternatives, there's market is open, transparent, etc., etc. So therefore, if an investor is investing in another company, it might not be a market value. It might be a measure of worth or investment, right? Market rent is the same case with rent, lessee, willing lessor, and willing lessee, etc., etc. Equitable value, on the other hand, equitable value reflects the prospective interests of two parties. Let's say an example of this. It happens a lot. Um, the CEO, or so let's say the owner of a company, let's say it's a private company, the owner, let's say a family business, um, forces or it decides that the company is going to lease the office from a specific asset in which the founder owns. So let's say it happens a lot in our countries, right, where the founder of a company owns an asset, let's say an office floor, and they rent it out to their company for tax benefits, in order to achieve a certain sort of profit and loss. You don't want the company to own the asset. The asset is owned by the founder because the company has other shareholders. They don't want, the founder doesn't want the shareholders to share his ownership in his assets. It could be for any kinds of reasons. Well, there's an equilibrium point, between rent and sort of lease that makes it beneficial for both parties. If the lease goes up too much, then it's a burden on the company. If it goes down too low, then it doesn't give the right tax benefits. And from the other side, the owner, if he rents it for too much, he will pay a lot of personal income tax. If it goes too low, then it's not really a good return. So the equitable value is an example of where the valuer has to understand the context of the relationship between the buyer and the seller, or the lessor and the leaser, the lessee and the lessor, to understand where the equilibrium point is and to reflect that respective interest. There's another kind of special value, which is the investment value. Investment value reflects the interest of the investor. So an investor will not buy a plot of land or a piece of asset unless it's worth investing in it, right? And how's that measured? There's discount rates, there's WACs, there's all kinds of investment theory behind risk and return that we're not going to be covering in this course, but in this webinar. But there's a whole science behind it. But worth is a measure of investment value. It's the value for that investor. It could be the same as market value if the asset is an investment property, anyways, and it's only being transacted among investors. Or it could, and there's differences between investors. Every investor has a measure of their worth depending on their required rate of return, etc., for their projects. Or it could be completely different. There's a different kind of basis of value, which is synergistic value. Here's an example. It's called marriage value. Synergistic value is the result of the combination of two or more assets or interests, where the combined value is more than the sum of the separate values. Sounds confusing. Let's explain this in examples. Here's a main road. Here's a high street. Okay. Here is assets, two different types of assets. You have asset A, asset B. They're both commercial plots, right? And here's asset C. Let's say the permit, the building, the zoning allows you to build a commercial. If you have a commercial plot of land, you're allowed to build on that plot of land using a certain ratio. Let's say using 40% footprint, 3 floors high. Okay, and obviously the larger your plot of land, the larger your building. So if you were to build a plot, a commercial, let's say mall, or an office building, or a mall, let's say, this is how the building would look like. If you were to build on B, this is how the building would look like. If you were to, now here's a prime building, it's on the main road. Here's a subprime building, it's on a side road. Versus if you were to combine the two plots A and B, make them into one merged plot, you can build a bigger building, double the size of, combined size of A and B in terms of building, and it's all prime on the main road and has both access on the main road and the side road. What would be valued? What would be higher in value? A plus B or C? In which case, sometimes in an example like this, actually C, which is exactly the same size. Let's say this is a 50, this is a 5,000 meter square plot. This is a 5,000, and this is a 10,000. That 10,000 meter here is worth more than this 5,000 meter plus this 5,000 meter. This is an example of synergistic value, right? Liquidation value, it could be orderly, it could be forced, in which case the two different, whether it's orderly or forced, are completely different outcomes. Orderly could be typical marketing period. Forced is a shortened marketing period. It is expected this would be less than this one, right? We discussed the liquidation. Now, fair value is defined in the, it's not defined actually in the IVS, except that it says that the fair value is equivalent to market value if it's a market transaction. But in fact, in guidance notes, it says that the fair value is whatever is fair. So all these other bases of values, the context of the framework, whatever the framework produces is the fair value, right? Whatever you choose based on the context and the purpose and the premise is what's fair for the deal, right? But if all these things are absent, fair value is most likely the market value, right? That brings us to the sixth component of the framework, which is the approach. There are three approaches according to the standards. There's the market approach, the income approach, and the cost approach. A nice way to explain the approach is an attitude, right? What is an approach? It's the way you look at things, is your point of view, right? So a market approach is a perspective of a merchant of goods. Like I'm looking at this kind of a trade. There's supply and demand. There's the economics of supply and demand. Therefore, the fair price, that's why we call the fair value or the fair price, is at the equilibrium point. Therefore, the fair price or the fair value is the market value. This is why it's called market approach, because it's market value. It's an estimated amount at market equilibrium point, right? And the deciding factor for the buyer and seller is getting the best deal. Getting the best deal given the alternatives. Why would I? Not all assets are created equally. Some have better location, some have better accommodation, some are in better condition. But given all the pros and cons of your asset, what is the best deal I can get given the alternatives that I have in the market at the moment? What's the equilibrium point? Not all assets are actually assets are not a commodity like tomatoes and in the open market, but you do have some adjustments. Okay, do I pay extra for this extra room? What about the condition? What about the location? But again, the dynamic happens in an open market. The approach, the perspective, or the point of view is that of a trade, buying and selling. This completely changes when you're looking at the income approach. The income approach has a completely different perspective, has a completely different attitude. It's the attitude of an investor, right? An investor can either put their money in equities, right, meaning in the stock market. They can put them in government bonds and sort of risk-free returns. They can put them in commercial property. They can put it in residential property. For them, it's investment vehicles. All these are just investment vehicles for them. The participants are usually institutional funds, portfolio managers, or a small time that understands finance, understands investment. They usually have a portfolio that they're diversifying or spreading risk and reward. Therefore, to them, the deciding factors are investment KPIs, return on investments, IRR, internal rate of returns, ROE, return on equity, risk spreads, etc. This is how they look at assets in light of the other investment vehicles that they can use. It's just a tool for them, and property is just another tool of investment. This can influence your method again. So in a market approach, your typical method is a comparative transaction method, but for the income approach, your typical methods are investment methods or the profits method, right? So again, the approach affects your method and affects your way of looking at the property. The third approach or the third attitude is that of a developer or a contractor, the cost approach. For them, I'm building something, right? I'm buying ingredients, land, cement, concept. I'm designing it. I'm developing it. I'm studying the market. I'm seeing where the project can succeed, how I can make a best profit, the highest profit given the market conditions, etc. They're seeking good economics and a reasonable profit margin, right? If I'm buying something used, therefore, or if I'm buying something that's already built, it's going to have to be better. It's going to give me a better deal than constructing it myself, right? If I'm going to construct it myself, I'm at risk, of market conditions, inflation. It takes time to build it. But if I buy something used, well, yes, that gives me the immediate um, sort of immediate effect. I can get it immediately, but again, I have the other kinds of risk, which is, remaining useful life, deterioration. Do I have to fix things in it? I don't know what's hidden in the walls, etc. So, these are the kind of this is how the cost approach looks at things. It's like, you know, you're, what's the depreciation? What's the profit? Replacing values, replacing existing property by means of construction or by purchase. This is how they look at things. So they look at from a development perspective. And the typical methods definitely used are either the top-down approach, which is the residual method, or a bottom-up, which is the DRC, depreciated reduced cost method. Those are the sort of the three approaches on how they affect your method. And therefore, there's a relationship between the approaches and the methods, right? According to the standards, there are 5 kinds of methods. There's the comparative or the comparative transaction method. There's the investment, the depreciated replacement method, right? The depreciated replacement cost method, DRC, the residual, and the profits. These are the 5 methods according to the standards. Therefore, a market approach, it touches upon all the methods. There's always market yields in your investment. There's always market rents. There's always market discount rates, agreed. So market is actually across all methods. But, directly, the market is sort of involved in the comparative method, right? And directly in sort of the top-down residual method when it comes to doing a cash-on-cash residential property, for example, transaction. The perspective of the income touches upon the investment method, the profits method, and also the residual method. If you're looking at the residual of a commercial property, an income generating property, it also involves some perspective from an income perspective. This is why the residual method covers mostly the development appraisals. So it's the 410, the 410 asset class, the residual method, right? So all the other ones are 400. This was 410. So it's the additional aspect of the development appraisal. And the cost, again, is the DRC directly, and also component of the residual method. So therefore, the approach, again, this is the approach is your attitude, is how you should, is the hat that you're wearing. Are you wearing the hat of a trader, the hat of an investor, or the hat of a contractor or developer? And then the methods basically combine those different attitudes in your application of your valuation. So what are the 5 methods of valuation? Comparative transaction method, DRC, sometimes also referred to as contractors method. The investment method, which is broken down obviously to traditional and DCF. Traditional is broken down to straight capitalization method, and term and reversion, or hardcore layered techniques. I mean, there are all kinds of techniques when it comes to these kinds of investment methods. There's the profits method. The profits method could be on a capitalization basis or a DCF basis. Again, there's breakdowns of that. Then there's the residual method, which are typically also 3 types, the type A, B, and C. And this is, for you guys to join us in future courses to perhaps get more training on these methods and how to apply, go through some case studies, and hopefully achieve excellence and competency in applying this framework in the actual methodologies that a valuer has to go through in their day-to-day work. This summarizes the framework. Essentially, again, revising this, the type of amount or the assumed use, the type of amount, and then the assumed use, and then the purpose of valuation, the premise of value, the basis of value, the approach, and method. Here's a quick way of running through. I just left in the slides for you some examples. Let's say here's a case. You get a value in an apartment. As a valuer, you have to go through this thought process. What is the type of amount? What is the type of asset? What is the purpose of valuation? What's the premise? What is the basis? What's the approach? And what's the method? And you have to basically reflect that in your report. And justification, even of the use of methods, etc. It's called a justification, right? So you have to sort of argue that in the report. So, here's an example, case study. You'll be asking the question to the client, what is the purpose of the valuation? And the client responds and says, the bank required that I conduct a valuation as part of my application for a mortgage. And you ask him, okay, what's the type of asset and what are you planning to do with it? He says, it's an apartment in a residential building that I will buy and live in. Therefore, automatically, you're an experienced and seasoned valuer. You understand that you're doing a value determination, not a cost, not a price, not a worth. It's a residential freehold, right? Freehold that is owner occupied. I'm going to buy and live in it, right? The purpose is to obtain a bank loan, right? So it's going to be used as security. Its existing use, it's definitely not going to be liquidation or highest and best rating. It's going to be ongoing concern. The person is going to be living in it. It's going to be using it. Most of the apartments, when they liquidate anyways by the bank, they liquidate at market value using existing use. They're not going to be sort of, removed from their place, disassembled or sold or salvaged or anything like that. So it's existing use. The basis of value is obviously the market value. It's going to be sold at market value. Therefore, you're going to be using the market approach, the trader's hat, and you're going to be using the comparative transaction method, right? Another example is valuing a shop. What's the purpose? I need to obtain a bank loan. What is the type of asset? And we're going to be planning to use it. It's a shop in the street. I plan on leasing it to a tenant. Therefore, this is an investment property. So if this is an investment property, then, again, you're going to be producing a value, not a price, not a cost, not a worth. It's a commercial. So you're going to be selling or you're going to be getting a loan against the leasehold, right? You're going to be going to the bank and you're going to be telling them, I'm buying this mortgage and I'm getting this kind of lease. So the bank's going to be measuring an II ratio, interest to income ratio. Is going to be, measuring your loan to value ratio, etc. It's going to cover the risk when it comes to tenants, etc. Tenancy and occupancies and so forth. What's the purpose? Again, to obtain a bank loan to be used as an asset as a security, obviously backed by the income and the lease of this asset. Its existing use. So even if the bank repossesses it and sell it, it's going to be in the same sort of state. You can either use the market value or the investment value. In both cases, going to give you the same. If the rent is market rent, it's going to give you a market value. If it's not, then it's going to give you also a market value, but a reduced or an expanded, a reduced one, or a discounted one, or a premiumed one, depending on the kind of lease that's on it, vis-a-vis the market value. Or if you're selling it to an investor with a sort of required rate of return, then you're looking at investment value. Again, you're going to be using the income approach, obviously, whether it's a straight cap method or term and reversion, and you're going to be sort of applying the traditional investment method, right? I have 8 other case studies here. I'm going to leave it to you with the slides.